In May 2025, Sebastian Siemiatkowski, CEO of Klarna, one of the world's largest buy no pay later companies, made a statement that almost no executive ever makes in public. He said, "Cost unfortunately seems to have been a too predominant evaluation factor. What you end up having is lower quality." That admission was not about a product that failed in testing. It was not about a pilot that never scaled. It was about a decision that had already been celebrated, globally, by name, with a specific number attached, 700. That was the figure Klarna had announced 14 months earlier, the number of human jobs their AI assistant could now replace. The announcement had made headlines at CNN, the BBC, Fast Company, and Gizmodo. The CEO had called it a breakthrough in the practical application of AI. So what happened between the breakthrough and the admission? Before Klarna, Sebastian Siemiatkowski worked shifts at Burger King. He lived on welfare checks. He paid his bills by cold calling small business owners, selling them short-term loans against their outstanding invoices. What that job taught him was not finance. It was something older than finance. He learned that people do not give you access to their money because your product is efficient. They give it to you because they believe you will not disappear when something goes wrong. In 2005, he and two Stockholm School of Economics classmates founded Creditor, later renamed Klarna. The idea was simple: let shoppers buy today and pay within 30 days, or split it over 4 installments. No interest if paid on time. Merchants paid Klarna a percentage of each transaction in exchange for higher conversion rates. For 14 years, Klarna was quietly profitable. Not famous, not viral, just a business built on a mechanism that worked because customers trusted it. Then the pandemic arrived. And in 18 months, everything that had taken 14 years to build was repriced by markets that no longer valued patience. By June 2021, Klarna had raised a round that valued the company at $45.6 billion, the most valuable private fintech in Europe. A company that had spent a decade earning trust was now being priced on growth. In 2019, Siemiatkowski had made a deliberate bet: sacrifice profitability to capture the United States market. The bet required spending at a pace that only made sense when capital was cheap. In 2022, capital stopped being cheap, interest rates rose, online shopping volumes normalized, credit losses widened, and in 12 months, Klarna's valuation fell 85%, from $45.6 billion to $6.7 billion. Losses for the year, nearly $1 billion. The company that had been worth more than many European banks was now fighting to survive its own growth. The next decision Siemiatkowski made would define the decade. The cost-cutting began in September 2022. Klarna cut approximately 700 employees, 10% of its global workforce. The announcement cited changing economic conditions. Internally, it was the beginning of a larger restructuring. 2 months later, OpenAI released ChatGPT. Siemiatkowski, by his own account, contacted OpenAI within weeks and made an offer: use Klarna and its 100 million customers as a live testing environment. He wanted to be, in his words, OpenAI's favorite guinea pig. Klarna became the first fintech in the world to launch a ChatGPT plugin. By early 2024, the build was complete. On February 27th, Siemiatkowski posted the results on X. In its first 4 weeks, Klarna's AI assistant had handled 2.3 million customer service conversations, 2/3 of total volume. Resolution time had dropped from 11 minutes to under 2 minutes. Repeat contacts fell 25%. Customer satisfaction scores on par with humans. Projected annual saving, $40 million. The equivalent headcount displaced 700 full-time agents, the same number as the layoffs, 18 months earlier. Klarna was clear that the two events were unconnected. The outsourced agents had not been Klarna employees. They worked for large third-party support firms that contracted with hundreds of companies simultaneously. When Klarna reduced its support volume, those agents were simply reassigned elsewhere. No one, technically, had been let go this time. The public received this distinction with mixed conviction, but the metrics were difficult to contest. The technology was real. The savings were real. The satisfaction scores were real. A company that had lost nearly $1 billion in a year had found a $40 million annual improvement and delivered faster service in the process. For an executive preparing a company for an IPO with investors who would read every efficiency ratio in the prospectus, this announcement served two purposes simultaneously. It cut operating costs, and it told a story. In Klarna's eventual IPO filing, the word AI appeared 207 times. The math was simple. The logic was sound. On paper, this was exactly what a rational leader under extreme financial pressure was supposed to do. But there was something they didn't calculate. Before we dive into the next part, let me ask you something. Here's a test. Count how many times you did the exact same task this week. Now multiply that by 52. If you're running a business doing $500,000 to $10 million, you already figured out the hard part. You've got customers, you've got revenue. But here's what nobody tells you. The bigger you get, the more you become the person handling all the stuff nobody else knows how to do. Approving invoices, scheduling calls, answering the same questions over and over. And the weird part? Most of that can run itself now. It's not about spending a fortune or hiring a tech team. Most business owners just don't know where to start. So we built something simple, a 2-minute survey. You answer a few questions about what's eating your time, and it shows you exactly what's automatable in your specific business. Links in the description. Takes 2 minutes. You might be surprised what you find. Now let's get back to the story, because what happened next changed everything. The cost of automating a trust product. Klarna is not a software company. It is a company that asks 100 million people to hand over their payment details, trust it with their money, and believe, without evidence in the moment, that when something goes wrong, the company will make it right. In financial services, every customer service interaction is not a transaction. It is a trust renewal event. The AI assistant was, by the standards of early generative AI, genuinely well built. It pulled from Klarna's Help Center and live account data. It responded in 35 languages. It processed 2/3 of all volume on day one, but it carried limitations that the launch metrics were not designed to detect. The chatbot took up to 20 seconds to respond to basic queries. In a text-based interface, 20 seconds of silence is long enough for a user to assume the system has broken. Abandonment rates climbed. Sessions ended before answers arrived. The responses it generated were accurate, but they didn't sound like Klarna. They sounded like a language model. The formulaic apologies, the identical sign-offs, the M-dashes. Customers noticed the texture. What was supposed to feel like Klarna's support felt like software wearing Klarna's logo. And for the interactions that mattered most, disputed refunds, account locks, fraud investigations, pending payouts, the chatbot could parse the question, but had no authority to resolve it. The answer was always the same: escalate to a human, which meant the customer repeated their entire situation from the beginning to a human agent who had no context from the conversation that had just failed. The loop was functional. It was not good. 6 months after the launch announcement, Fast Company reported that customer satisfaction had fallen sharply. Klarna had begun pulling software engineers, designers, and marketing staff into customer support roles to cover gaps the metrics had not predicted. The Better Business Bureau recorded over 900 complaints in 3 years. The dominant category, refunds and billing disputes. Precisely the issue type the chatbot was least equipped to close. What the February press release had counted was containment, how many conversations the AI could close without escalation. What it had not counted was resolution, whether the customer's actual problem had been solved, and whether they still trusted the company when it was. Those are not the same measurement. The distinction had been available to examine before the announcement. No evidence suggests it was examined. And by the time the data made the gap visible, millions of interactions had already passed through a system that was optimized for the wrong outcome. The financial results, for a time, justified the decision. In 2024, Klarna reported its first annual profit since 2019, $21 million net on $2.8 billion in revenue. The AI assistant contributed an estimated $40 million to that outcome. Headcount fell from 5,500 to 3,400. The company went public in September 2025 at a $15 billion valuation, a significant recovery from the trough, though still 67% below the peak. In the narrow terms of a balance sheet prepared for public investors, the automation had performed. But something had happened simultaneously that did not appear in any quarterly report. When Klarna automated its outsourced support function, it replaced not just the labor, but the accumulated context those agents carried, the understanding of how Klarna customers escalate, what language de-escalates a billing dispute, which types of problems require patience and which require speed, which customers are about to churn versus which customers just need to feel heard. None of that had been documented. None of it had been transferred. It had lived in the relationships between agents and the company, built over years of direct contact with real customers. And when the invoices changed, it left with the people. A language model trained on Klarna's Help Center did not inherit it. There was also a detail that received little public examination at the time of the announcement. Klarna was preparing for an IPO, a $40 million AI efficiency story placed inside a prospectus that mentioned AI 207 times is not simply an operational decision. It is also a narrative. And when operational decisions and investor narratives are constructed at the same time by the same leadership team for the same announcement, it becomes genuinely difficult to determine which one was driving the other. Siemiatkowski has not been accused of bad faith. The savings were real. The efficiency gains were real. But the question of whether the decision would have been made the same way on the same timeline without the pending IPO, that question has no clean answer. By May 2025, the reversal was public. Klarna launched a pilot to hire remote support agents in an Uber-style flexible model. 2 agents had enrolled. The company's new official position: AI gives us speed, talent gives us empathy. 14 months earlier, the official position had been that the AI performed on par with humans. Neither statement was false. Together, they describe a company that learned the difference between performing on par and being equivalent after 100 million customers had already experienced the gap. There is a distinction Klarna's story makes visible, though the company never framed it this way. The diagnostic question Klarna asked in 2023 was, how do we reduce the cost of customer support? That question had a good answer. The AI provided it. The question Klarna did not ask was, which interactions inside customer support are actually doing the work that keeps customers? Not all customer service is the same. Some of it is processing, confirming orders, answering frequently asked questions, updating addresses. That work is automatable. Its removal creates almost no customer experience impact. Some of it is something else entirely. The moment a customer is deciding whether to trust the company again after something went wrong. That moment cannot be faster than human. It cannot be cheaper than human. It can only be better, or it costs the relationship. Klarna automated both categories simultaneously, measured the results in the first, and discovered the cost in the second one later. The data that would have separated those 2 categories existed before the decision was made. No evidence suggests it was separated. These questions do not have clean answers. That is not an accident. In your business, which tasks look repetitive and which tasks only look repetitive because you've never had to explain what goes wrong when they're done badly? If your automation created a failure your current metrics cannot detect, how many months would it take you to find out? And what would already be gone? When you calculate what automation saves, do you include the value of what gets quietly removed along with the cost? And do you have a way to measure that value before it disappears? Don't click away yet. See that video on my left? Click it right now. The next story shows what happens when a business fixes the right constraint first, or the wrong one. You need to see this. Click that video and keep watching.